There's a rule that sits at the foundation of almost every retirement account, every financial advisor's pitch deck, and every smart investing article your uncle shares on Facebook. It's a rule so widely accepted, so deeply embedded into the financial system, that questioning it feels borderline illegal, like showing up to a funeral and asking if the dead guy maybe had it coming. The rule is simple. Put 60% of your money in stocks, put 40% in bonds, rebalance once a year, go touch some grass, repeat until retirement. That's it. That's the whole strategy. That's what trillions of dollars in retirement savings are built on. And for about 5 decades, it worked. It wasn't glamorous, it wasn't going to make you rich overnight, but it was reliable. When stocks crashed, bonds went up. When bonds struggled, stocks carried the weight. And they zigged when the others zagged. It was the investing equivalent of a balanced diet, boring, predictable, and exactly what every doctor tells you to do. But in 2022, something happened that wasn't supposed to be possible. Stocks crashed, and bonds crashed at the same time. Not a little, not a minor blip. Bonds had their single worst year in over 100 years of recorded market history. Meanwhile, the S&P 500 dropped nearly 20%, and the classic 60-40 portfolio, the one your financial advisor has been selling you for years, dropped about 16 to 17% in a single calendar year, which doesn't sound catastrophic until you realize this was supposed to be the safe option. This was the portfolio designed specifically to not do that. So either 2022 was a freak one-off event that will never happen again, or something more structural is broken underneath the surface. And I think you already know which one it is, otherwise I wouldn't be making this video. Let's start at the beginning. The logic behind 60-40 wasn't random. It was based on a very specific, very consistent historical relationship between stocks and bonds. The relationship is called negative correlation, which in plain English just means when one goes down, the other tends to go up. And for most of modern financial history, that relationship held up remarkably well. Here's why. Think about what happens during a recession or a market panic. Investors get scared. They sell stocks. And where do they put that money? They buy bonds, specifically U.S. Treasury bonds, because treasuries are considered the safest asset on the planet. So money flows out of stocks and into bonds. Stock prices fall. Bond prices rise. The 40% bond allocation acts like a parachute when the stock side of your portfolio is in free fall. And this worked beautifully from roughly the 1980s all the way through 2020. 40 years of the correlation doing exactly what it was supposed to do. 2001 dot-com crash, bonds rallied. 2008 financial crisis, bonds rallied. 2020 pandemic sell-off, bonds rallied. Every single time the stock market had a meltdown, bonds showed up like a responsible adult to stabilize the room. So it's completely understandable why the entire financial advisory industry built their entire business model around this one relationship. It was the most reliable pattern in modern investing history. And then inflation showed up and set the rulebook on fire. Here's the thing nobody explains properly about bonds. A bond is not a savings account. When you buy a bond, you're lending money to a government or a corporation. In return, they promise to pay you a fixed interest rate, called the coupon, for a set period of time. Sounds straightforward. But here's the crucial part most people miss. Bond prices and bond yields move in opposite directions. Always. It's not a trend, it's math. If interest rates go up, existing bonds become less attractive because new bonds are being issued at higher rates. So the price of your existing bond falls. And if rates go up a lot and fast, which is exactly what happened in 2022, when the Federal Reserve hiked rates from basically 0 to over 5% in under 2 years, bond prices don't just dip, they collapse. The Fed executed the most aggressive rate hiking cycle in 40 years. Every single bond portfolio on the planet got absolutely obliterated. The Bloomberg U.S. Aggregate Bond Index, which is basically the benchmark for investment-grade bonds, fell over 13% in 2022. That's not a typo. The supposedly safe 40% of your portfolio dropped 13%. And the 60% stock side, down nearly 20% at the same time. Both legs of the stool snapped simultaneously. And here's the gut punch. The people who got hurt the most weren't day traders chasing meme stocks. They were retirees. They were people in their 60s and 70s who had done everything right, who had listened to their financial advisors, who had built the boring, responsible 60/40 portfolio exactly like they were told to. And they watched years of savings evaporate in 12 months because a strategy built on a 40-year-old assumption quietly stopped working. Now, and this is important, the obvious rebuttal is that 2022 was a unique situation, a once-in-a-generation inflation spike, a policy error by the Fed, a black swan, won't happen again, go back to sleep. And maybe that's true, but here's why I don't buy it. Because the conditions that made 60/40 work for 40 years aren't coming back anytime soon. And if you understand why those conditions existed, you start to understand why the rulebook is genuinely broken, not just temporarily glitchy. The 60/40 portfolio was born in a specific environment, one where inflation was under control, interest rates were on a long-term downward trend, and the Federal Reserve had room to cut rates aggressively whenever the economy stumbled. That rate-cutting ability was the entire engine behind the negative stock-bond correlation. When stocks crashed, the Fed cut rates, which pushed bond prices up, which cushioned the blow. But what happens when inflation isn't dead? What happens when the Fed is stuck between cutting rates to save the economy and keeping rates high to keep inflation from ripping back? What happens when the Fed doesn't have the same ammunition it had for the past 4 decades? You get a world where stocks and bonds can fall together. And that world is not hypothetical. We already lived it in 2022. And the macroeconomic setup going into the rest of this decade looks more like 2022 than it looks like 2009. Because here's what the current landscape actually looks like. The United States is running a deficit of over $1.8 trillion annually. The national debt just crossed $36 trillion, which means the Treasury has to issue massive amounts of new debt every single year just to keep the lights on. That supply of new bonds has to be absorbed by someone. And as global buyers of U.S. debt, Japan, China, foreign central banks slowly pull back, yields on long-term bonds have to rise to attract new buyers. Higher yields mean lower bond prices, and lower bond prices mean the 40% parachute in your portfolio has a hole in it. Meanwhile, if inflation stays sticky, and with deglobalization, tariffs, and an aging workforce, there are serious structural reasons to believe it might, the Fed's ability to ride to the rescue with emergency rate cuts gets compromised. Because cutting rates aggressively into a high inflation environment is how you get the 1970s. And nobody wants the 1970s, except maybe people who really love disco. So you end up with a scenario where both legs of the 60/40 structure are under pressure at the same time. Stocks are expensive by historical standards. Bonds are structurally challenged by rising debt supply and sticky inflation. And the correlation that held everything together for 4 decades is no longer reliable. And this isn't some fringe view from a guy on Reddit who stores gold in his basement. The biggest institutional investors in the world have been quietly walking away from 60/40 for years. Pension funds, endowments, sovereign wealth funds, they've been piling into alternatives, private equity, real assets, infrastructure, commodities, basically anything that isn't purely dependent on the old stock-bond relationship holding up. The average large university endowment now allocates less than 10% to traditional bonds. Yale's endowment, one of the most sophisticated portfolios on the planet, has been running a tiny bond allocation for over a decade. The smart money figured this out long before 2022. The question is why the financial advisory industry is still selling the same product to retail investors who have no idea the formula changed. And the answer, if you're being honest with yourself, is pretty uncomfortable. Because 60/40 is simple to explain, simple to sell, and simple to justify when something goes wrong. It's a long-term strategy. Stay the course. It's also cheap to implement. Stick someone in a target date fund, collect a fee, move on. The business model of financial advice runs on simplicity and recurring revenue, not on constantly updating 50-year-old frameworks to match a new macroeconomic regime. Which brings us to the real question. If 60/40 is broken, what actually works? And I'm going to be straight with you here. There's no clean replacement. There's no new 2-number rule that solves everything. Anyone telling you there is selling something. But there are a few frameworks that actually make sense in the world we're living in now. First, if you want real diversification, you need assets that don't move together. And in a high inflation, high debt environment, that means looking at things like commodities, TIPS, which are treasury bonds indexed to inflation, so they actually hold up when inflation runs hot, real estate, and international equities outside the US. Not because they're exciting, but because they actually behave differently from each other. Second, the bond duration problem is real. Long duration bonds, the 20 and 30-year stuff, are the ones that get destroyed when rates rise. Shorter duration bonds, like 1 to 3 year treasuries, are far less sensitive to rate moves and still provide some stability. If you're going to hold bonds, understanding duration is no longer optional. Third, the 60-40 assumption was always that bonds provide stability. But in the current environment, cash and short-term bills are actually doing a better job of that than long-term bonds, which is why Buffett has been sitting on a mountain of treasury bills. It's not that he's scared, it's that cash and short-term instruments are actually competitive now in a way they haven't been in 15 years. And fourth, and this is the uncomfortable one, if your entire financial plan is built on autopilot around a rule from the 1970s, you probably need to actually look at what you're holding. Not because the world is ending, but because the world changed, and your portfolio might not know that yet. Here's the real irony in all of this. The 60-40 portfolio wasn't designed to be a permanent, universal law of investing. It was a practical heuristic for a specific macroeconomic era. An era of falling rates, low inflation, and a Federal Reserve with plenty of room to maneuver. That era produced the greatest bond bull market in history, a 40-year run where bond prices basically went up in a straight line. And in that environment, 60-40 looked like genius. It looked like a timeless rule. It looked like the kind of thing you could chisel into a stone tablet and hand down to your grandchildren. But it was always just a product of its environment. And the environment changed. It's just that nobody updated the tablet. So the next time someone tells you to stay the course with your 60-40 because it's historically proven, ask them which history they're referring to. Because the history that made 60-40 great ended sometime around 2021. And what we're living through now is a new chapter that the old rulebook never accounted for. I'm genuinely curious where you land on this. So drop your take in the comments. Do you think 60-40 is just temporarily broken and will work again once inflation settles? A. Or do you think this is a permanent structural shift and the entire framework needs to be replaced? B. Or option C, you had no idea your retirement account was built on a 50-year-old assumption and you're now quietly panicking. Drop it below. And if you want more of the stuff that traditional finance media won't cover because it doesn't get clicks, hit subscribe, because the boring topics are always the most dangerous ones.